Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi Dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today, we are taking a closer look at an important development in the global foreign exchange market involving the Vietnamese Dong and discussing why international currency movements deserve attention, even for followers of the Iraqi Dinar. According to the latest market data, the USD VND exchange rate increased to 26,295 points on July 18, 2026, representing a 0.16% rise compared with the previous trading session. While this may appear to be a relatively small movement, experienced market participants know that even minor fluctuations can reveal important information about investor sentiment, capital flows, and the evolving economic outlook. In the foreign exchange market, currencies rarely move in isolation. Every change, whether large or small, reflects millions of individual transactions influenced by trade activity, monetary policy expectations, investment decisions, and global economic confidence. A movement of only a fraction of 1% can influence multinational corporations, importers, exporters, banks, and institutional investors that manage billions of dollars in international transactions every day. Looking beyond today's movement provides an even more meaningful perspective. Over the past month, the Vietnamese Dong has strengthened by approximately 0.13% against the US dollar, indicating that the currency has shown resilience despite continuing uncertainty across international financial markets. At the same time, when measured over the previous 12 months, the Dong remains approximately 0.52% weaker than it was a year ago. This contrast demonstrates why professional economists avoid drawing conclusions from a single trading session. Financial markets constantly experience short-term volatility driven by news events, economic reports, and changing expectations, but long-term currency performance depends on broader structural factors such as productivity growth, inflation management, export competitiveness, fiscal discipline, and confidence in monetary institutions. A currency can experience temporary gains while still facing longer-term challenges, just as it can experience temporary declines despite maintaining strong underlying economic fundamentals. This is why experienced analysts compare daily, monthly, quarterly, and yearly performance before evaluating whether a meaningful trend has truly developed. The Vietnamese economy continues to attract international attention because of its expanding manufacturing sector, growing export base, increasing foreign direct investment, and integration into global supply chains. Vietnam has become an important production hub for electronics, textiles, machinery, and consumer goods, supplying products to markets around the world. These economic strengths contribute to long-term demand for the Vietnamese Dong, although external pressures, such as global interest rate changes, fluctuations in commodity prices, slowing international demand, and movements in the US dollar, can still influence short-term exchange rate performance. Like many emerging economies, Vietnam must balance economic growth with inflation control while maintaining investor confidence and ensuring that its currency remains stable enough to support domestic businesses and international trade. One of the most important concepts highlighted by this market update is the distinction between the spot exchange rate and the forward exchange rate. Although these two terms are frequently mentioned in financial reporting, they serve very different purposes within the global financial system. The spot exchange rate refers to the current market price at which one currency can be exchanged for another for immediate settlement. This is the exchange rate most commonly displayed on financial news websites, banking platforms, and currency exchanges. Businesses making international payments today generally rely on the spot rate because it reflects current market conditions. However, companies involved in international trade often cannot wait until the day a payment becomes due, because exchange rates may change significantly before a future transaction takes place. This is where forward exchange contracts become an essential financial tool. A forward exchange rate is agreed upon today for a transaction that will occur at a specified future date. Instead of accepting the uncertainty of future market movements, companies can lock in today's exchange rate and eliminate the risk that unfavorable currency fluctuations could increase costs or reduce profits. For example, an exporter expecting payment several months from now may use a forward contract to guarantee the value of that future payment regardless of where exchange rates move in the meantime. Likewise, an importer purchasing goods from overseas can secure future exchange costs and prepare budgets with greater certainty. Banks, multinational corporations, investment funds, and financial institutions rely heavily on forward contracts because managing currency risk has become an essential component of modern international business. These agreements are not designed primarily for speculation, but rather for reducing uncertainty and improving financial planning. Understanding the relationship between spot and forward exchange rates also provides valuable insight into market expectations. Forward rates often incorporate differences in interest rates between two countries as well as expectations regarding inflation and monetary policy. They do not necessarily predict where a currency will trade in the future, but they reflect pricing based on current financial conditions and available market information. Professional investors recognize that currency markets are influenced by countless variables, making future exchange rate movements impossible to predict with complete certainty. Instead of relying on speculation, institutions use sophisticated risk management strategies that allow them to continue conducting international business regardless of short-term market volatility. For followers of the Iraqi Dinar, this development involving the Vietnamese Dong should be viewed primarily as an educational example of how managed exchange rate systems function, rather than as evidence of any direct change affecting Iraq's currency. Vietnam and Iraq each operate under monetary frameworks in which central banks play an active role in maintaining financial stability and supporting confidence in their domestic currencies. However, similarities between managed exchange rate systems do not mean that developments in one country automatically influence another. Every national currency reflects its own economic conditions, fiscal policies, political environment, institutional framework, and monetary objectives. The Iraqi dinar continues to be influenced primarily by domestic economic developments. These include banking sector modernization, improvements in payment systems, implementation of financial reforms, anti-money laundering measures, regulatory oversight, government fiscal policy, oil production and export revenues, foreign currency reserve levels, inflation management, and decisions made by the Central Bank of Iraq. These factors carry significantly greater importance for the future direction of the dinar than movements occurring in unrelated foreign exchange markets. While observing international currencies provides useful educational context, responsible analysis requires distinguishing between general global trends and country-specific economic realities. Foreign exchange markets represent one of the largest and most liquid financial markets in the world, with trillions of dollars changing hands every day. Exchange rates adjust continuously as investors respond to economic data releases, central bank announcements, geopolitical developments, employment reports, inflation statistics, interest rate expectations, commodity price movements, and international trade developments. A stronger US dollar can place pressure on many emerging market currencies simultaneously, while improving investor confidence may encourage capital to flow toward developing economies. Nevertheless, the extent of these movements varies considerably from country to country, depending on each nation's economic fundamentals and policy responses. Central banks occupy a critical position within this process. Institutions such as the State Bank of Vietnam and the Central Bank of Iraq monitor inflation, maintain financial stability, oversee banking systems, manage foreign exchange reserves, and implement monetary policies designed to support sustainable economic growth. Their responsibilities extend far beyond determining exchange rates alone. They must carefully balance economic expansion with price stability while maintaining confidence among domestic and international investors. This balancing act becomes increasingly complex during periods of global financial uncertainty, when capital flows and international investment patterns can change rapidly. Another important lesson from today's update is the value of maintaining a long-term perspective. Currency markets naturally experience daily fluctuations that may appear significant in headlines, but often have limited long-term implications. Professional economists avoid making sweeping conclusions based on isolated movements, because sustainable currency trends develop over months and years, rather than hours or days. Short-term volatility is a normal characteristic of financial markets, and should be interpreted within the broader context of economic fundamentals rather than viewed in isolation. For Iraqi dinar observers, maintaining this disciplined perspective is particularly important. Monitoring official announcements from the Central Bank of Iraq, following developments in banking modernization, evaluating fiscal reforms, observing improvements in financial regulation, and analyzing macroeconomic indicators provide a far stronger basis for understanding Iraq's monetary outlook than attempting to draw connections between unrelated currency movements. International developments can certainly broaden our understanding of how foreign exchange markets function, but each currency follows its own economic path shaped by national priorities and domestic conditions. Ultimately, today's movement in the Vietnamese Dong reminds us that foreign exchange markets remain dynamic, interconnected, and influenced by a wide range of economic variables. Even relatively modest percentage changes can provide valuable information about market sentiment and evolving economic expectations. At the same time, these developments should always be interpreted carefully, with proper attention given to the broader economic context rather than isolated headlines. For followers of the Iraqi dinar, the most constructive approach remains focusing on verified information, official policy decisions, banking reforms, economic diversification efforts, reserve management, and macroeconomic developments within Iraq itself. By maintaining a balanced evidence-based perspective and avoiding unsupported assumptions, investors and observers can develop a deeper understanding of both global currency markets and the specific factors that truly influence the future direction of the Iraqi dinar.